We're good. Let's go.
All right. Welcome to episode 2 of Think at Heart. This is Ben Hart, the namesake of the Hart Investment Group, and I'm Scott Goodfellow, the
Hello,
trusty
hello.
side.
Hey,
How are you?
I'm good. You?
Good. Well, we talked. How do you think episode 1 went?
Pretty good. Pretty good. I mean,
Yeah.
I think we're gonna find our way, but I think it went good. I think we gave a
Yeah.
good high level start.
Yeah, for sure. Yeah,
Yeah.
for sure. I think we're going to be able to boil it down and create some themes around what this thing's going to be and what the overall podcast and themes are.
Yeah.
I think we have a little more direction today, so
Yeah.
we're just going to get right into it. One of the things that we talked about before was, you know, last time we talked a little bit about our backgrounds, and we determined just kind of throughout the week that, it might be a good angle because I have 20 years as an entrepreneur, so I really know Main Street. And before I kind of came into this business, the markets are always something that I watched but never really understood, right? I couldn't understand how something would trade at 50 times earnings, right? And where the value of these companies are and how could we really sustain those kind of multiples,
Yeah.
right? Same thing with you look at companies like Tesla and companies like that just seem to be overvalued. I'm like,
Yeah.
how does this value still keep going up? Or situations like now where we're in
Yeah.
lockdowns, the economy's never been worse and the market still goes up, right?
Yeah. Yeah.
So I always look at it from, you seem to take it in stride
Hmm.
because you just know that's how the market works, right? And I'm
Hmm.
like, I'm freaking out over here going on Main Street like this, looking at all these businesses that have no cash flow, right?
Yeah.
Because I know what it takes. I've seen the cash flow. These guys, have to pay people. They got to keep the lights on, and that's how they run their business, right?
Yeah.
So I think that's how we're going to move forward. It's kind of going to be, I'm going to challenge things versus,
Yeah.
the everyday guy.
Sure.
So we're almost positioning it as Wall Street versus Main Street,
Yeah.
right? So you'll play
Yeah.
the Wall Street side, I'll play the Main Street side because really that's where we're at,
Yes.
right?
Yes.
So
Let's.
let's just start with that
Okay.
then.
Yeah.
You touched on a little bit last time, but let's talk a little bit. Let's get a little more in depth of it and talk about how is it that in an economy like we have now,
Hmm.
how do the markets be as hot as they've ever been? How does that make sense at all?
Yeah, so look, it's a great question. It's been a learn too. When I started in the business, I wouldn't have thought that either. As I think I mentioned on our call last week, yeah, I studied Benjamin Graham, Warren Buffett, Peter Lynch, like these value investors that, what's the intrinsic value of a company? We want to buy something below intrinsic value and wait till it realizes its value and then we sell it. And so, that can work over us. That has worked over a super long cycle in Buffett's case. But Buffett's certainly underperformed the market in the last 6, 7, 8 years.
Mhm.
So it's been a learning curve for me too, because my base kind of thinking was around valuations. And so when I came into this business, I thought, okay, I'll look for those companies that trade at a discount. I'll look in a sector, say like financials, for example. I'll analyze which one has the best, trading below book value, and I'll buy that one and sell it when it realizes that. Well, I came into the business in 99, 2000. So we had this kind of momentum trade that was going on. And I remember attending like lecture after lecture about how momentum investing was this new thing and that value investing was dead. And so, you kind of learn about, like, I remember following this guy. His name was Derek Webb. I don't know if he's still managing money or not, but he was at a firm at a time, and his numbers were spectacular. Like he was killing everybody. And I thought, hang on a second, like he's buying these companies that, IPO that don't have cash flow, they have negative cash flow. Like, why are these going up? Like, why are they going up 1,000% when they open? Why is this happening? And so that was kind of the first time that I started to think about the fact that, maybe value investing isn't the only way to make money. And that was the first time I learned it. And so now, as I've gone through kind of different levels of bull and bear markets, we've reached a kind of a new paradigm where I think that I'm not going to say this time is different, but I think the way the market is built and the way the market interacts with the different information has changed a lot. People used to own stocks for 3 to 5 years, and they had that kind of long cycle built into it. But now you get money flowing into the market. You get instant information. You get the market reacting off of this instant data flow, which is very different than the fundamentals. Which you would look at a business and go, I want to buy this company because it trades at a discount. And if you're assessing a business as an entrepreneur like you did the last 20 years, you'd go, okay, here's this business, here's the cash flow. Maybe it makes sense to put an offer in, but that's not how the market trades today.
Yeah, but doesn't that just and this is certainly something I thought before is doesn't that just support the view of playing the markets just the same as gambling? Like really, like you're making somewhat educated guesses on what you think may or may not happen with these companies, right? And it seems like there's no rhyme or reason to it. Like when stocks go up, it makes no sense why they're going up. They lay off, lay off 10,000 people and the stock goes up.
Well, I mean,
You know?
that happens because that's better for the company, right?
Right,
Yeah,
right,
they're cutting their costs. So
right,
that's
right.
typically why the stocks rally on that kind of news. But you know
Yeah,
as for the gambling aspect to it, uh to some extent, yes. Like if it's blind educated, like you walk into a casino and you're going to play blackjack, you never played blackjack before, you're going to go in there, you're going to spend a bunch of money, and maybe you win, maybe you lose.
hmm,
And so that's the everyday investor that goes to online. They look at the top 20 stocks in the market, for example, or they go to like Robinhood, right? The Robinhood lists the top 10 stocks in the holdings, and they're gonna go in, they're gonna willy-nilly pick one of those, and they might get lucky, and they
that's
might
right.
get lucky a few times.
That's right. That's right.
Yeah,
Yeah, exactly. Well, and I think that's the general consensus of the majority of people, certainly in my circles, which is more of the main street circles, right?
yeah,
I go to the rink, I talk to the hockey dads who are, employees or entrepreneurs, and they have a main
yeah,
street view, and you talk
yeah,
about the market, and nobody has any idea of how it actually works,
for
right?
sure.
And since I've been in it now, and had to go through the whole process and study and figure out all the terminology and all that stuff and learn about a little bit more how it works,
Yeah,
I certainly understand better of how it works,
yeah,
right? But the everyday person will never understand that, nor do they really need to,
no,
right? But I think
no,
that's one of the things that keeps people away from the market,
I
putting
think
their
so.
money into it. You
Yeah,
know what I mean?
yeah,
Is it's just so overcomplicated with derivatives and selling underlying assets and bonds and yields and right. That's just not something people are interested in. When really, I mean, if people just put a little bit of time into it to understand a basic view, and I'm
yeah,
hoping that's something that we can do on this podcast.
sure.
Is hopefully that's my rule is kind of to, I don't want to say dumb it down
Yeah,
for people because I think that kind of diminishes people's intelligence, but that's not the
yeah,
point. But
yeah,
really make it into chewable sizes so people can understand
right.
more of the strategies that you put in place, like high level guys like you that put it in
Yeah,
place that makes sense, right? That
yeah,
offer that growth, but maintain that safety, like that
yeah,
whole thing, right?
yeah, yeah,
Because
yeah,
everybody wants to go in, put their money in, they hear all these stories of, oh, I put my 25 grand in Bitcoin and now it's worth $1 million.
yeah.
That's the Main Street guy's, dream
Take
come true,
for
right?
sure.
That's his
Yeah,
dream come true. That's the way that he sees the market, right?
yeah, yeah. So I
So,
mean, definitely, this is the classic one I get from people and clients. They're like, I just talked to my neighbor Jim, and he bought XYZ, and it went up 50%. Why didn't we buy XYZ?
yeah.
And so people have that kind of narrow view around that. You only hear the good ones. You only hear about the good trades. from everyone.
Yeah. Yeah,
Yeah,
exactly.
yeah,
Exactly. And there's so many different strategies, right? I
yep,
mean, you follow a couple people specifically. I mean, you touched on a little bit about Warren Buffett and his value-based trading. And what's funny is that you mentioned that he's been crushed by the market like the last 6 or 7 years. But certainly, if you watch the media, it doesn't seem that way,
that's right.
right?
Yeah,
They still call him the Oracle. He still seems like he's never made a mistake,
yeah,
right? Like that type of thing. That's all promotion. But
yeah,
there's, I think, and for coming from a Main Street side, that like his way of investing makes sense, probably the most sense to me,
yeah,
right?
yeah,
But now just being in it for the short time that I've been doesn't
yeah,
make sense to me at all,
yeah,
right?
yeah,
I understand,
yeah,
especially nowadays where I think you have to look out so much further down the road in order to get value out of your trades, right? Like,
yeah.
um,
Yeah, so I mean, I think what happens is you got a couple of choices when you manage money, right? You got the choice as an advisor or portfolio manager. You choose to not try to understand it and give the money to somebody else to manage, which is the majority, or you find a way to come up with a view and a thesis that you can execute on a repeatable basis, over the long term. And so, you know, most advisors choose the route where they give the money to somebody else to manage on their behalf, and then the advisor's job ultimately is to, I guess, manage asset allocation. And so, maybe I should talk a little bit about asset allocation, because that is a kind of a complicated answer, like a complicated word where people like, what does that mean?
well, let's go back. So you're telling me that some advisors, so if I'm the client, right? I'm Joe Blow that owns a small business and I've got 100 grand to put in or 250 grand to put in.
Yeah,
I give it to an advisor and then they give it to somebody else. Is that
that's
what happens typically?
that's typical. Yes, yes, yeah, yeah. So look, you go into any firm in Canada, and you got obviously lots of choices, but typically they're either going to give it to someone in their back office to manage, like of somebody behind the scenes makes the decision and they just sit in front of it, or they'll give it to a mutual fund company, and that mutual fund company obviously executes all the decisions where the advisor doesn't make them. And of course, if you go into every bank branch in the country, you sit in front of them, and Joe Blow with $250,000, sit in front of them, and you go through this questionnaire, which spits out a risk profile, and then you end up investing in a fund of fund, which is, you probably own something like 5,000 stocks and bonds, over many different investment managers that really don't have an integrated, decision, and there's nothing unique for you. It's just what the bank has put together for clients that fit your risk profile.
So what's the role of the advisor there then?
uh so I guess the role of the advisor is to assess the risk tolerance. I mean, if they're at the bank, they're probably doing some credit analysis as well. So maybe they're coming up with a savings plan or something that you can do to get to some other goals. But it wouldn't be investment anyway. In my opinion, it wouldn't be investment advice.
Right.
Yeah.
Right. So, yeah, I mean, you're really not going to make much money in that type of investing, right?
Well,
Like
uh,
that's your safety. Like people that just want to go in and make 1 to 3% and
mhm.
right. Is that typically where you're at with those types of things?
Yeah. So I mean, depending on what you invest in, and depending what the market does, I think you can do okay. I think the difference now is that we're at a point where, what worked over the last 40 years is probably not going to work over the next 40. I think we've talked about this before. I mean,
Hmm.
Markowitz was this gentleman that came up with this asset allocation strategy, which is you own this much stocks, you own this much bonds. If you do that effectively, depending where you are on that risk curve, you're going to get a different rate of return. So when this was created, we look back, we'll say in the mid 80s. It's actually before then, but like hypothetically in the mid 80s, say you had 40% of your portfolio in bonds. Well, for certain you're going to get, 6% out of your bonds. So that's your base, that's your risk-free assets. So in order to get to kind of 10 to 12% rate of return, well, it wasn't too hard. You didn't have to step really far out on the risk scale to get to that 10% rate of return. But today, if you're invested in 40% of your portfolio in bonds, well, if you're owning government bonds, which was his recommendation at the time, your return is 1%, 1.5%. And so, when you think about that, if you have a 40% portfolio in bonds earning you 1%, and you got 60% of your portfolio in stocks, and say you want to get to 10% rate of return, well, those 60% of your portfolio of stocks are going to have to kill it in order for you to get
Right.
yourself there. Yeah.
Right. That
Yeah.
makes sense.
Yeah.
Well, and I think that's the thing, right? I mean, if I come to you, right, again, going back to the main street, if I have the approach where I want to make money in the market,
Yeah.
right? I
Mhm.
come to you, you're my advisor, and I
Yeah.
say, I want to actually make some money here, right?
Yeah. Yeah.
Um, what I mean, obviously you're not going to stick me in mutual funds and like I won't be happy with 1 to 3%.
Mhm.
You know what I mean?
Yeah.
So, do you think the market's a good place to make money? First of all, like if I'm looking to make money?
Yeah. So, I mean, one of the cool things about the market is it can be anything. It can be
Hmm.
a place to make money. It can be a place to preserve your capital. It can be a place to just be slow and steady. It can be any of those things.
Yeah.
So, I mean, I think one of the unique challenges that we have as advisors or portfolio managers is to assess your understanding with risk and your comfort with it. And
Hmm.
so I think that when people come to me for the first time, a lot of times the answer is, I want to make a number. That's their
Hmm.
starting point, right?
Hmm.
Right. So, you know, what I try to accomplish by the end of my kind of initial meetings and initial getting to know people is, you know, how much are you comfortable with that? You tell me you want to make 10%, you tell me you want to double your money, like, like, I need you to understand what the risk is with those types of views in mind,
Right.
right? So if you can, sorry, go ahead.
No,
Yeah,
if
yeah.
there's a point, yeah.
Yeah, so I mean, if you come to me and say I want to double my money, well, that kind of expectation comes with maximum risk,
Right.
right?
Yeah, yeah, for sure.
Yeah.
But I think that's, what you said before about, um, the market can kind of do whatever you want it to do
Hmm.
is I think something that's not understood. Certainly, I didn't understand that coming in, right? If you want to preserve capital, then it can do that. If you want to use it as a way to make money, then you can certainly work it to a way that you can certainly strive to accomplish that, right? By taking more risk. And then, like you
Yeah.
said, it's understanding that it's just a matter of risk tolerance, right?
Mhm. Mhm.
Right. So
Yeah,
it's
and
interesting.
that's the challenge, right? You come to me with $1 million and you
Mm-hmm.
say you want to make 20% returns. Well,
Mm-hmm.
in order to do that, you have to be willing to understand that, yeah, there's a high probability at some point over the next few years, you're going to have a 50% drawdown in the portfolio. So if you got
Mm-hmm.
$1 million invested, say it grows to 1.2 million,
Mm-hmm.
but then we have a 50% correction, and it drops into, you drop to 600, 700,000.
Hmm.
Can you handle that? With the knowing that, that 700,000 will probably triple again at some point.
Hmm.
Like, and so, you know, I think one of the things is that people don't understand that.
Right.
And majority of clients that I've met and dealt with over the years also can't handle it,
Right. The risk,
the
because
risk.
they can't handle volatility.
Can't handle it.
Abs- Yeah, yeah. I could definitely see that. Right, especially if it was all your money. I think some people that maybe, like you mentioned, $1 million, if you have millions of dollars and you've kind of allocated kind of in a few different areas, right?
Mm.
And then we take this amount and we're going to make this one grow, right?
Yeah.
Do you see that strategy often where, different risk tolerances for different percentage of their money?
Yeah, so it can be that way. I mean, I
Mm,
typically take that holistic view where, you show me what's your pool of money, and then we agree on how we're going to get there. So I would look at different chunks within the portfolio with different risk profiles. If you got money in your investment account, in a corporate account, in a tax-free savings account, and an RSP, you get these kind of four different places, and you can take different risks in each of those places. So, typically, say in that scenario, you got 100 grand in your TFSA, for example.
yep.
That'd be a good place for you to take some of that kind of a bigger risk, from the perspective that if you do have a good success rate, you're not going to pay any tax on that gain, of course.
Mm,
So each of the different places, you may take different setups.
gotcha.
Yep.
Gotcha.
Yep.
Cool. Well, yeah, certainly. I like where that's going from a standpoint of really kind of demystifying the market and everybody thinking everybody has to go in the same bucket and you have to
Right.
know what stock. Like, honestly, I think a lot of people just think they got to pick, you know, from a group of companies and that's how you invest, right?
Right.
Like, oh, I'm going
Yeah.
to pick these six companies and put all my money in these six companies and
Yeah.
hope they do well, right?
Right.
But there's so many other ways to invest, right?
There really is. There really
Yeah.
is. I mean, and a lot of the historical research around kind of how returns work, I think, aren't as useful as they used to be,
Hmm.
because, how returns are made now are quite different. And
Hmm.
so, if you look at kind of a profile, the historical research says, I think, from a diversification in the stock portfolio, anytime you get over 25 stocks, there's a kind of a laws of diminishing returns.
Hmm.
So you don't need to own more than 25 stocks.
Hmm.
I tend to disagree with that. And I tend to think, if you were invested in Europe over the last 10 years, you made $0. So if you own 25 stocks in Europe over the
Hmm.
last 10 years, you still made $0.
Yeah. Yeah.
So,
Yeah.
so you got to think about where that money's invested.
For sure.
Yeah.
So one of the strategies, and certainly one that you're big on, is the macro strategy, right?
Yeah.
So why don't you talk a little bit about what that is and how that plays into, well, just what that is in general.
Yeah, so it's definitely been something that I've been interested in for a long time, is kind of the macro picture and how that has an impact on markets. And
Hmm.
so I'd say probably the last 10 years I've really spent a lot more time trying to understand the macro picture. So it'd be the macroeconomic picture and how that relates to the markets. Right.
Hmm.
So, historically, the market tended to lead the economy, and it tended to lead it by 6 months, we'll say. So you could take a kind of a view where, the market is saying where the economy is going. And so I spent a lot of time trying to understand that. Um, I try to look at that global picture as well, because I think we get so focused on Canada and North America. So I was trying to understand how that how they related to each other. And so that kind of goes back to your first question about why are the markets doing something when the economy is doing something else.
Hmm.
And so as I learned and learned, I followed a lot of different research people and individuals. And then about 3 years ago, I landed on following this company called Hedgeye. And so Hedgeye is a research firm. They do institutional research out of the US, and they sell most of their high-end stuff to hedge funds. And they've built a computer that analyzes real-time data on economic data. And so this is global data. Every single global input that comes in out in the world gets generated into their computer. Obviously, they pull it out of Bloomberg and then goes into their system, and they come up with these different types of analysis based on the real-time data. And so one of the challenges before was a lot of economic data is very backwards looking. It's very delayed. And so when you by the time you get the data, it had you know you can't trade off that data like you would have before. So Hedgeye has done a lot of research around their algorithm that continues to digest this information. And so what that comes out with is you get real-time data on what's happening on a day-to-day basis, and they have a predictive algorithm that gives their opinions on where the different spots in the world look the most attractive, and then the different companies, and then then the different industries, different companies. Anyways, it's a pretty detailed economic think tank that most people don't pay attention to or have access to, but it's been very good at helping with that predictive thinking and algorithm around where the world's going. And so what the are you back?
Yeah, back.
I think I lost you for a sec. Yeah.
Yep.
Yeah, and so so what I do every day now is I take a look and analyze what comes out, what gets spit out, and it helps me think about what's happening on a day-to-day basis. So it's helps with the short-term views on what's happening in the markets. And so we've touched a little bit on the quadrants that they've developed,
Hmm.
and it helps you think about what sectors do well at what different parts of the cycle. And that was something that yeah, I always knew intuitively that different asset classes did well at different times. But what I didn't know is how and what the setups were for those to play out. So, we're in this kind of, we'll call it the quad two, which is growth plus inflation. And the great thing about knowing these different things is what does well in the different types of pockets. And then the what I do and what I have to make decisions on is how do I allocate and how do I execute on those strategies.
Gotcha.
Yeah.
So just mention the quadrants again. I know we talked about a little bit of last time, but
Yeah.
so right now we're in which quadrant again?
Quad two.
Quad two. And what are some of the industries that do well in that typically? Do you
Yeah.
remember?
Yeah. So it'd be commodities would do well, financials do well,
Yeah.
um, technology typically does well in this part of the cycle too, emerging markets, things like that. So, what doesn't do well is typically the U.S. dollar,
Mm.
um, and the unique challenge is what happens when that quad flips.
Mm.
And as you look out, and as I look out into the horizon, it looks like on the other side of this is quad four, which is not good for most other things.
Mm-hmm.
Which, if we go into that quad four environment, you get into that stagflation, which is falling inflation or deflation and slowing growth together,
Mm-hmm.
tends to be U.S. dollar strength, uh, bond strength, and some of the things that most people don't have exposure to.
Okay. So again, going back to the main streets,
Yep.
what does that mean? Like, obviously,
Yeah.
it's from your client standpoint, but if I'm
Yeah.
an investor and you
Yeah.
see that coming on the horizon,
Mhm.
like, what's a strategy to capitalize? Is there a capitalize, or is it like a buckle up and we just try to make it through a quad like that?
Yeah. Yeah, so it's a great point and a great question. And so I think that sometimes you get stuck in a thinking that I have to do things one way, and you can't make money in a down, we'll call it down equity market, right? And so, the answer to that is you can always be better positioned. If you know with a pretty high certainty that we're going into that environment, well, you can make some changes. If you are in an all equity portfolio, tilted towards technology, if you're lucky enough, for example, then you can take some profits and allocate it to long bonds at this point, or you can take some profits and just keep some of that in cash. Or if you're sophisticated enough, you can buy puts, because they're getting fairly cheap now as an
Hmm.
insurance. That can and puts are like, basically like insurance. Hypothetically, say you invest $10,000 in it, a market falls, that 10,000 could be worth 100,000. So it's like an
Hmm.
insurance policy. Um, so there's always something you can do to prepare for that.
Okay,
Yeah,
gotcha.
yeah.
So speaking of, some more specifics, what are we looking at right now? What are we interested in? Let's talk about some more fun stuff as far as, um, you know, what what's interesting in the world of investing right now. I mean, I hate to I hate to bring it up every time, but Bitcoin's always in the news, right? Crypto in general. It's kind of, I don't know. Some people are starting to, as it's getting more exposure, right? There's more people that are digging more into it. So I think
Mhm.
there's going to be some more things that come out about it. Where do you
Yeah.
think it's at? Where do you think Bitcoin and crypto's at right now?
Yeah, it's pretty interesting, extremely unique. And as I think about it over my career, there's not many things that I can remember that are similar to this. And
Hmm.
so I know Paul Tudor Jones talked about gold being like this in the 70s, where you couldn't really trade it yet. So there's a lot of similarities around what's happening now with gold and Bitcoin. But I got to be honest, this week was kind of the first week that I started to get a little bit nervous. And so as I talked to clients, and I had a call with a client this week, and he said, a very sophisticated guy too, and he said, everyone I talk to now talks about putting their cash into Bitcoin, like money from their bank account into Bitcoin. And they're not kids. These are people like in their 70s that are
Hmm.
telling me this.
Wow.
Yeah, yeah.
Yeah. Yeah.
And obviously we had, this couple of people sent me this article over the weekend, and we're recording this on January 17th. So sent me the article about, Tether and how that plays a part in crypto. And so, um, I haven't done my own thorough analysis on that, but as I read through that article, I start to think about how important it is for it to be regulated sooner than later. And
Yeah.
so, yeah, and my hope is that it continues to be an alternative asset class and continues to be what I think it could be, but it needs regulation. And Tether, which we could talk about in more detail, seem to allow people to put leverage on, and transact outside of the United States. Both those things are concerning for the price. So, if you get a quick, you know, drawdown where hypothetically maybe Tether got into trouble, the market could overreact because leverage can come out of the system quite quickly.
For sure.
Yeah.
I think I agree with that. I mean, it's certainly something that I've been following pretty closely and trying to learn as much as I can about, because one of the things I I have learned since joining the industry is to look forward and probably my strategy is to look the way that I think the world is going to be like,
Yeah.
period of time. And I do think
Mm,
crypto in general, I don't know about Bitcoin, specifically, things like Ethereum are
mm,
going to be the platform that people actually transact in on a day-to-day basis, right?
yeah.
And Bitcoin is going to be more the store of value, is kind of my understanding of it,
Yeah.
kind of at a high level.
Mm,
But
mm,
so I do think I'm not. I agree with you from a standpoint of I think there's definitely going to be some skeletons that come out of the closet, right?
yeah.
That will reveal some things that were maybe been going on behind the scenes
Mm,
that could cause a correction,
yeah.
right?
Yeah.
But the experts in that area have been saying that all along, and
Yeah.
there a lot of the experts that I listen to as well have been saying, like, look, this thing is going moving too fast. You
Yeah.
know what I mean? It wasn't
Yeah.
made to grow like this quickly. If we
Yeah.
want it to do what it is designed to do, right? Um, then it needs to slow down. So I think that's going to be the correction we see. Yeah, are you going to see some skeletons coming out of the closet and some negative news? Absolutely,
Yeah.
right?
Yeah.
Um, it, to you, like it's more of like how do you deal with that in the portfolio is something different,
Yeah.
right?
For
But
sure.
but I still am bullish on the long-term view of crypto, right?
Mm, mm,
Short term, yeah, I think we're getting ready for maybe something negative is going to come out soon.
mm. Yeah, I mean, look, it is a volatile asset class. When I think about it, well, from a composition perspective within a portfolio, it's just like anything else, like obviously crypto holders, like people that want to hold it forever, and it's such a narrow view where I've seen enough people blow up in other stuff in their careers where
Hmm.
you get an 80% weighting in Nortel, or you get an 80% weighting in US financials, or you only own precious metals, or you only do this. That's not how you manage money for people. At least that's not how I manage money for people. So if you've had success in that area, well, you trim it back and look for something else that has potential. And to your point, well, maybe Ethereum's part of it, and maybe you stay within the crypto space, or maybe you take some of those profits and you buy Square, or MicroStrategy, or something else that's a little bit more established, that allows you to kind of move up the food chain, and preserve those profits. But it's not ever an all-in single decision. That's a good way to wreck your financial picture.
Yeah, for sure.
Yeah.
So yeah, so we're watching it is basically what we're saying.
Yes.
Like
Yes.
if you asked us 2 weeks ago, we're ready to bet the farm, or certainly I was. I should I shouldn't say that about you because that wasn't true. But
Yeah.
yeah, I certainly have had my bullish times on crypto for sure.
Mm.
Okay, what else is interesting? What else is interesting right now?
Yeah, I think that basically, because I have the view that we're in this kind of this inflation plus growth period, the you want to own anything that does well with a weak US dollar. So again, I think it's temporary, but you want to own emerging markets. So I think you'd probably want to look in different places. And if you want to keep it simple, you can just buy the ETF. But I'd be looking at some of the other countries that I think have a better risk reward. Like you want to own like maybe a Brazil or a Russia, if you're comfortable with those countries. But you'd look at kind of those places. There's some individual companies that look attractive, but I think that the general view is that I think you can own EM, you can own commodities, you can own some individual Canadian companies that are tilted towards energy and commodities. Yeah. Uh, but I think we're in the latter part of that trade. So I look at, we've had corn, we've had like potash, and these some of these commodities go vertical over the last few months. I think we're starting to get to the end of that cycle. I think there's still money to be made, but as I always look forward, I'm trying to think about, okay, at what point do I pivot away from that, and what do I pivot to at that point? But right now, I think there's still money to be made in this space. And
Right.
so as we came into last week, obviously market sold off a bit on Friday. As I look at futures tonight, they're pretty flat. Bonds are up a little bit, crypto's up a little bit. But if the market's down on Monday, I think there's a chance to use some of the cash to buy stuff.
Okay.
Yeah,
Awesome.
yeah,
Well, all that sounds super boring since I'm a Main Street guy.
yeah,
Hey, Main Street guy, I like to hear about companies and industries that I understand,
yeah,
right?
yeah.
So things that I like, and I want you to respond to these, right?
Yep,
Because
yep,
as investments, right?
yep.
So the thing that I've learned since entering this space is to kind of like, as I mentioned before, is kind of have that longer term view.
Yep.
And since right now, I would look at the stuff that I know and actual companies that I know, like I mentioned,
Mhm.
I look at things like travel,
Yeah,
right? Like, oh, travel's never been worse because people can't travel. Yeah, but down the road, I think there's going to be an explosion of that, right?
yeah,
And
yeah,
I look at just main like key indicators that are easy to figure out. Like if you go on and try to book trips anywhere right now,
yeah,
super expensive,
yeah,
right?
yeah,
Look at the book for 2022, right?
yeah,
If you look to
yeah,
book out, people think they're going to go on and get a deal. No, because
mm,
I think there's going to be a huge explosion in travel, and
yeah,
people are just sick of sitting, not being able to travel for 2 years,
yep,
right? It just
yep.
makes a little sense. Now, I think a lot of that is, I think the time to buy travel was probably, 4 or 5 months ago.
Mhm,
And you have
mhm.
like, I think Expedia at $100, $99 would have been great. Now it's at
Yeah.
100. It's back up to 140, I think.
Mhm, mhm.
Yeah,
Yeah,
it's 140,
yeah,
like those types of things. But I think there's still going to be massive value because I think they're going to have a huge spike when it comes back. Same thing
yeah,
with the cruise lines. If they could, the trick with the cruise lines, right, is going to be the ones that actually make it through because they're
yeah,
just so leveraged now. I mean, they have billions and billions of dollars of debt that
yeah,
I don't know if they'll be able to. It'll kind of be if yeah, how long they can hang on, right?
yeah,
So I don't know. Maybe you can have a quick speak to how you see that fit in.
yeah. So I think that a little bit about how I would think about this is, back in 2008, I kind of had that view that none of the financials would fail.
Hmm.
And so I learned through that period that, just because a company didn't fail before, it certainly could in the future. So I would take a view that, if I'm going to buy travel, I'm probably going to look to do it in either, if I want to own the airlines, for example, I'm probably going to do it with an ETF. There's an ETF you can buy called JETS, which is JETS, that trades in the US.
Hmm.
Um, there's if you want to and are bold enough, certainly you can buy some individual names. And if you chose to do that, then I'd really dig into the balance sheets,
Hmm.
and say, how long can they survive before their cash flow gets back to a reasonable level?
Yeah.
I mean, as for the cruise lines, yeah, I mean, look, we've had that discussion for multiple months, and still I'm not convinced that they all make it through. The only way I guess I would consider playing that is Harvest in Canada launched an ETF called Travel. I think it's TRVL. So it would give you exposure to the cruise lines and the airlines together.
Hmm.
So you could play it from a trade perspective.
Yeah.
Yeah,
I like that
yeah,
actually. I
yeah,
like that for
yeah,
sure.
yeah.
Yeah. I mean, and again, from the Main Street side, looking at things that are happening in the future, I've been a big esports guy,
Mhm.
right?
Yes.
So the reason for that is many.
Yep.
I look at the way that people interact and the way that real sports are now and the way
Mhm.
that kids interact with looking, basically they watch video games all day.
Yep.
Either they're playing them or they're literally watching them like pay-per-view. they're interacting with video games the same way that you and I interacted with real sports when we were that age,
Yeah.
right?
Yeah.
And you already see, professional leagues popping up. You're seeing record breaking. I want to call it TV time, but
Yeah.
that's not what it is. But live streams is basically what it is,
Sure.
right?
Yeah.
And I just think that that's going to be the future of sports,
Yeah.
right?
Yeah.
And you're seeing that, like, the market is saying so,
Yeah.
with a lot of these companies, that are I mean, it's just a rope straight up almost since
Yeah.
last March.
Sure.
So I don't know what your take is on that.
Yeah, so mixed views. I mean, I don't know if you followed GameStop this week, but there was a massive short interest on GameStop, and then the company earnings started to pick up. They did quite well. I think the stock was up 150% last week.
Hmm.
So I think that. But as for the bigger ones, as you mentioned, like EA Sports and things like that. I
Yeah.
think that you got to really think about the companies you want to own. I think there's potential. Obviously, we see Roblox is coming out and as an IPO, and it's not obviously esports, but it's definitely that kind of computer engagement still with kids or technology engagement with kids.
Yeah.
So I think that, yeah, I think that there is potential with some of them. I think you want to own the bigger ones at this point. There is money to be made in the private market, but I don't, and we can't trade in the private market at the present time.
Hmm.
But you've seen a lot of these companies like Roblox just raised money before they went public, and they're doing a direct listing instead of an IPO. So they're coming to the market with kind of a different view.
Hmm.
But yeah, I agree with you. I think there's potential there. I think there's a lot of growth. I guess it's just the timing of when you want to own these things too. And I think
Hmm.
the next few months is probably a decent time if you're long them already. Like if you own them already, I think you can hold them. Um,
Hmm.
I'm I'm just not adding to positions right now. I do think if we see this sell off sometime late summer, early summer,
Hmm.
late summer, you probably get that chance to buy them at better prices. And ultimately, I'm trying to buy things that I think can work over the period of time I'm looking to buy them.
Sure. Absolutely.
Yeah,
Yeah, I mean, I want to just bring a couple of things like that are interesting from I think this is what the everyday people are looking at, right?
sure.
Are the industries that they know,
Yep.
right? Like everything
Yep.
that you talked about. So I'd like to kind of bring a couple things to the forefront. Like, hey, you know what? This is what's interesting to me. This is what people that I talk to talk about,
Yeah.
right? And the things that I see that have growth in the future, just
Yeah.
the way that the world is working, right?
Yeah.
For sure.
Yeah.
Okay, cool. What else, Mr. Wall Street? Hey, what
Yeah.
else, Mr. Wall Street?
Yeah. I think obviously there's lots of things that kind of I think pique my interest as I think about things in the market. And one of them is really interest rates. And while I know it's boring as heck for most people, when I think about it, I think, why is there such a discrepancy between where US interest rates are and the rest of the world? And so it makes me think a little bit about what's happening, what's to come, and where's the opportunities. But I'm watching interest rates really closely, um,
Hmm.
and I think that's going to have a big impact on what happens with pretty much every asset class in the world. So that something I'm paying attention to. One of the things we talked about before I think we went on the call was just about the time aspect. And there's been a lot of pressure around kind of making money right away. So there's a lot of pressure around the timing of things. And so that's starting to play into my thinking around portfolio positioning, and people are starting to get greedy again. And when people get greedy again, that typically means we're coming up on a sell off. And so I'm starting to think about time from many different perspectives. And we talked where before people would hold stocks 3 to 5 years, and then that came down to 3 to 5 months, 3 to 5 weeks, and now it's like 3 to 5 days. So um,
Yeah.
that
Yeah.
aspect is playing into things.
Yeah. I mean, if I'm thinking of, I think the everyday person, when they're thinking about putting money in, if I'm thinking like buy and hold, I'm thinking RSP. I'm just going to leave the money in there. It'll be there for my retirement. If
Yeah,
I'm thinking I want to put money on the market, I want a return,
yeah,
right? And
yeah,
and and I get that from talking to our clients
yep,
too.
yep.
Well, maybe less our clients, but people that are in the market too that want growth, right?
Mhm,
Is
mhm.
they want that more instant feedback. And again, going back to crypto, I think that's why people another reason people are like I can make money on this right now.
Yeah,
You know,
yeah,
um, it's had unprecedented growth. So I think that those are the types of trades that people are going to be looking to make,
yeah.
right?
For sure. And if that trade continues to work, it's going to continue to pull in more money.
Mm,
As I said, the one thing that most people forget about, and hopefully don't ever have to have the chance to experience, is that trade could be asymmetric to the downside against you.
for sure.
So at one day, if the central banks of the world come together, a la kind of Bretton Woods, and they say we're going to ban the use of Bitcoin as an
Hmm.
alternative currency. We're not going to
Hmm.
let it. We're not going to let you convert your Bitcoin into U.S. dollars, Canadian dollars, euros, sterling. Then it goes down immediately,
Hmm.
and it goes down 80%, 90%.
Yeah.
It's not like down 5.
Yeah.
And so
Absolutely.
when you have something unique like this that has a unique risk profile, it's something that you can never, I think, lose sight of that as well. And
Hmm.
so when it's in a portfolio, obviously you got to think about how much you want to have exposure to, and you need something that can counterbalance if you don't want to take too much risk. And
Hmm.
so one of the challenges that Bitcoin's had is they don't, as an everyday investor, there's not a great way to hedge the risk of that. If you're an institutional investor, you can buy futures, you can buy
Hmm.
puts, like you can buy protection on the downside. But
Yeah.
as an investor like us at the present time, there's nothing that gives you that perfect downside protection. So, I think about it within context of the portfolio. How much am I comfortable having exposure to? And also, if I have exposure to it, what else am I going to own that's going to go up if it goes down?
For sure. And I think that's been kind of somehow that's turned out to be the theme of this podcast is risk, right? Like
Yeah,
it really comes down to, yeah, there's huge opportunities, probably the most opportunities there's ever been, right, to make money,
yeah,
but it's what level of risk you're comfortable with,
yeah,
right?
yeah,
Um, so yeah, I think that's something we could certainly talk more about too, right?
for sure.
Is risk, how to manage it, get into a little more specifics about how that looks like in a portfolio and how to manage the risk and talk about puts and
Yeah,
you know
yeah,
things like that you know tools that you can use to manage those risks, right, to protect yourself.
yeah. And I think it's the one thing that I know when I talk to other advisors, they really don't have a concept of what risk is.
Hmm.
And when I talk to them about their portfolios, like yeah, I take a look at what else they're doing, and they don't really think about managing risk. They just think about return. And so
Yeah,
I think you do yourself a big disservice if you don't think about, you know, if what's the risk with everything that I'm doing. And I think it's a really important differentiator over what we do.
yeah. Well, you mentioned other advisors. It's probably the number one surprise for me since I've gotten into this industry with you is while talking to other advisors is um, their hands-off approach. Like very few people actually manage the money,
Yeah,
right?
yeah,
Where I always thought it was like every advisor just they did what you did, right?
Right. Right.
Which is actually manage the portfolio, right?
Right. Right.
That's not the case,
Mm.
and it's very surprising. Actually, I'm not sure that I've met anybody else
Mhm.
um, that that does it, and certainly doesn't do it like you,
Yeah.
right? A
Yeah.
lot of them just put it in funds, and I do that. I talk to other associates around and the advisors, and it's the same thing. And a lot of people think that you're crazy or that
Yes.
we're crazy, right?
Yeah.
Because from a standpoint of like, oh man, he's making all the decisions. They just don't want to be the ones making the decision because then they have that, the
Responsibility. Yeah.
responsibility to do it for
Yeah.
sure.
Yeah.
So
Yeah.
yeah, very interesting.
For sure.
Okay, cool.
Cool.
Well, why don't we wrap it up there? Number 2 in the books.
Sounds good.
Yeah,
Awesome.
I think we covered a ton of things.
Yeah. Me too.
You
I think
know,
that was
I
good.
Yeah, I think the approach of Main Street versus Wall Street, and I'm gonna craft some things that are really gonna come at you, things that I've noticed about the industry that I just don't understand or don't agree with,
Yeah.
and that doesn't make sense that's not, I don't think, in the best interest for the everyday guy, and you're gonna kind of try to rebuke those things, and maybe I'll even come at you
Or
with some
agree.
alternative. Yeah, yeah, exactly. Or you may
Yeah.
agree,
Yeah.
or I may come at you with some alternatives like, oh, hey, why is real estate a better investment than the market,
Look forward
right?
to that one.
I think
Leverage.
I think you're
Leverage.
gonna dominate me on that one already, but because I've already looked into that, but it's a view I certainly used to have.
Yeah, for sure.
Now I've been educated. Why not? And maybe we'll have a guest on about that one. But
Yeah.
anyway, okay, let's wrap this one up, and we will see you next week.
Sounds good.
Okay.
All right. Bye.